History is defined by dates that shift the world's axis. 1914 marked the collapse of old empires. 1971 marked the end of the gold-backed dollar, but the fiscal year of 2026 will be remembered as the moment when mathematics finally defeated ideology. It happened without a fanfare or a declaration of war. In 2026, the interest payments on the United States national debt officially crossed the $1 trillion mark. For the first time in history, the cost of servicing the past has exceeded the cost of securing the future. The U.S. government now spends more on interest payments than it does on its entire national defense. Every aircraft carrier, every nuclear silo, and every cyber command unit combined. Think about the weight of that reality. Every fourth tax dollar extracted from your paycheck is no longer building roads, funding schools, or supporting veterans. It is being incinerated in the furnace of debt service, interest on money that has already been spent, borrowed by politicians who are no longer in office. We are no longer a superpower with a debt problem. We have become a massive debts servicing machine that happens to have a shrinking military attached to it. Welcome to stage 6 of the wealth timeline. The interest trap has officially closed. The anatomy of the spiral. To understand how we reach this terminal velocity, we must examine the concept of fiscal space. This is the economic oxygen a country needs to breathe, the room to react to pandemics, wars, or natural disasters. In 2026, that oxygen has been sucked out of the room. For decades, the architects of modern monetary theory told us that debt didn't matter. They argued that as long as interest rates remained near zero, a $30 trillion debt was a theoretical ghost. But they ignored the most fundamental law of finance. Interest is a variable, not a constant. When the cost of borrowing rose to combat the inflation of the early 2000s, the theoretical problem became a mathematical executioner. We have entered what economists call a debt spiral. This is the point where the government must borrow new money simply to pay the interest on the money it previously borrowed. It is the financial equivalent of a snake devouring its own tail. When the Treasury must remove $1 trillion from the global system every year just to satisfy bondholders, that capital vanishes from the real economy. It isn't being used for private innovation, it isn't building new housing, and it isn't sitting in your retirement account. The government is crowding out the private sector, starving the engine of capitalism to keep the ghost of the state alive. The Japanification of the dollar. To see our future, we must look at Japan's past. For 30 years, Japan has been the laboratory for high-debt economics. They survived because their debt was owned by their own people. But America is different. The US dollar is the global reserve currency, and its debt is held by the world. In 2026, we are witnessing the Japanification of the US economy, but without the domestic high savings rate to support it. As interest payments consume the budget, the Federal Reserve is forced into a corner. If they raise rates to fight inflation, they bankrupt the Treasury. If they lower rates to save the Treasury, they trigger hyperinflation. This is the central bank trap. The Fed is no longer independent. It is a hostage to the government's interest bill. In 2026, the Fed's primary mission is no longer price stability or full employment. It is ensuring the government doesn't default on that $1 trillion interest payment. This shift marks the transition from a market-led economy to a state-managed survival regime. Interest versus defense, the symbolic collapse. For over a century, the strength of the American empire was measured by its ability to project power anywhere on the globe. The Pentagon was the primary line item of the American budget, a symbol of unquestioned dominance. But in 2026, the Pentagon has been demoted. It is now the second largest expense, trailing behind a line item that produces nothing: interest. This is not just a change in an Excel spreadsheet, it is a profound geopolitical signal of decline. When a nation spends more on its past debts than its current security, it is in a state of liquidation. This shift signals the end of the unipolar moment. In 2026, if a major global crisis erupts, the United States no longer possesses the financial shock absorbers required to respond. In 1941 or 2008, the U.S. could print and spend its way out of disaster because the debt-to-GDP ratio allowed for it. Today, any attempt to inject another $5 trillion into the system won't lead to a recovery. It will trigger an immediate currency collapse. The choice for the American leadership is no longer guns or butter. The choice is now interest or survival. The hidden tax of financial repression. The question most people ask is, if the government owes the debt, why does my grocery bill keep going up? The answer lies in the inflationary tax and a strategy called financial repression. Since the government cannot realistically raise taxes to a level that would cover $1 trillion interest gap without sparking a domestic revolution, they are left with only one lever: the printing press. But they don't just print physical bills anymore. They devalue the debt by ensuring that inflation always stays slightly higher than the interest rates you earn on your savings. By keeping inflation higher than the interest rate, the government slowly erodes the real value of what they owe. But in doing so, they erode the value of everything you own. Every time the interest bill hits the Treasury's desk, the purchasing power of the dollars in your savings account decays. This is the ultimate wealth transfer. The government's inability to manage its ledger is being balanced on the backs of the middle class. Your hard-earned savings are being used as the fuel to keep this debt machine running. It is a silent, invisible raid on your future. The crowding out effect and the private sector. Death. In 2026, the crowding out effect is no longer a textbook theory. It is a daily reality. To find enough buyers for $1 trillion of new debt every single year, the Treasury must compete with you for capital. They must keep rates high enough to attract global investors who are increasingly skeptical of the dollar's long-term stability. This is exactly why your mortgage is stuck above 6%. This is why a small business loan costs 10% or 12%. You are in a direct bidding war with the U.S. government for the available cash in the world. And the government always wins because it can print the money it needs to outbid you. This has created what we call the low growth ceiling. When the state is the largest, most aggressive borrower in the room, there is nothing left for the entrepreneurs, the builders, or the families. The private sector is suffocating because the lifeblood of the economy, capital, is being diverted to fund the zombie economics of the national debt. We are watching the slow death of innovation in favor of debt maintenance. The illusion of solvency and the confidence crisis. For decades, economists argued that the United States could never go bankrupt because it prints the currency in which its debt is denominated. While technically true, this ignores the fact that bankruptcy for a nation-state doesn't look like a locked courthouse door, it looks like a loss of confidence. In 2026, the world's central banks, the very entities that have propped up the dollar for 80 years, are beginning to ask, why should we hold the debt of a nation that spends $1 trillion a year just on interest? When foreign buyers pull back, the Federal Reserve is forced to step in as the buyer of last resort. This is the liquidity trap. The more the Fed prints to buy the debt, the higher inflation goes. The higher inflation goes, the higher interest rates must climb to compensate investors for the loss of purchasing power, and as rates climb, the interest payments on the debt explode even further. The cycle is closed. There is no traditional exit. We are witnessing the bifurcation of the economy. One side consists of the bondholders and the institutions that receive these trillion-dollar payments. The other side consists of the workers whose wages can never keep pace with the debt-driven inflation. The social contract is rendered void. The interest trap doesn't just destroy balance sheets, it destroys the social fabric. A government that spends more on its past than its future is a government that has abandoned its young. In 2026, we see the results. Infrastructure that crumbles because the maintenance budget was redirected to interest payments. Education systems that stagnate because there is no fiscal space for reform. Research and development that falls behind global competitors. The American dream was predicated on the idea that each generation would be wealthier than the last. But the $1 trillion interest bill is a lien against the future of every child born today. They are born into a system where they owe thousands of dollars for services they never received and for money they never spent. Act accordingly. $1 trillion in interest isn't just a number on a screen, it is a countdown clock. In the entire history of global finance, no nation has ever successfully inflated its way out of a debt spiral this deep without a total restructuring of its currency and its social contract. The American dream was built on the idea that the future would be better than the past, but a system that spends more on its past debts than its future security has already admitted defeat. The system is now working exclusively for the creditors at the expense of the creators. The interest trap is shut. The only question left is how will you protect your purchasing power before the mathematics of debt reaches its inevitable conclusion. Watch the debt clock. Monitor the real yields. The trap is set and the time for preparation is thinning. Act accordingly.